In this video, I'm going to unpack how to maximize your business vehicle deductions in 2024 by explaining two mistakes your CPA or tax professional is getting wrong that are absolutely killing your vehicle deduction. The first one is that they don't understand how depreciation works for a business vehicle. The way depreciation expense is calculated depends on whether the IRS classifies the vehicle as a luxury passenger auto, a heavy vehicle, or a vehicle that's not even subject to depreciation limits. So, depending on your circumstances, you may be able to write off 25% of a vehicle's cost, 80%, or 100%. Don't worry about this, I'll show you the numbers and I'll unpack all that and show you what I'm talking about. The second item that tax professionals, including CPAs, get wrong is what are commuting miles versus business miles. The more miles you can allocate to business versus commuting means a larger percentage of your vehicle is being used for business, and therefore you will get a larger deduction for it. This applies whether you're using the mileage or the actual method, and I'll show you how to convert commuting miles to business miles along with the IRS guidance so you can provide this information to your accountant if necessary. That said, before we dive in, because I'm going to show this to you on my screen, let me quickly introduce myself if it's your first time watching. My name is Navi. I'm a certified public accountant who teaches entrepreneurs how to save thousands of dollars in taxes. I do that by providing free content right here on social media, but I also do it through a comprehensive course, which is designed to convert business owners from knowing nothing about accounting and taxes and transforming them into tax-savvy entrepreneurs who implement strategies that save them thousands of dollars in taxes each and every year. So if you're interested in learning more, you can click on the link within the description below, or you can visit my website, which is navimuradcpa.com. Okay, so let me jump into what I want to show you here on my screen that I created. The first item that I want to discuss is the fact that vehicles are categorized in three different ways. You can have a vehicle that's what's called a luxury passenger auto. And by luxury, I mean, in general, and this is nuanced, right? But in general, it's a vehicle that costs $62,000 or more, and it's less than 6,000 pounds. And when I say 6,000 pounds, it's not, the regular weight, it's the gross vehicle weight rating. Then you can have a heavy vehicle. So this would be a vehicle that's over 6,000 pounds. And because it's over this weight, it's not subject to the luxury passenger auto limitations. And then you can have a vehicle that is not subject to limits at all based on either its weight or its use. Okay, so we're going to go through an example, and I'm going to show you how a Tesla, whether it be a Model S or a Model X, or even a Model S, depending on how it's actually being used in your business, can be depreciated at either 25.5%, 80%, or even 100%. So let's look at this first example. I'm saying here, you've gone out, you've bought a Tesla Model S. It doesn't matter that it's an EV, right? I'm just using this as an example as a car that's fairly popular these days, right? So you're buying basically any $62,000 plus price vehicle, and this vehicle weighs less than 6,000 pounds, okay? So the purchase price of the vehicle is $80,000. Well, how this works is by applying what I call the depreciation order of operations. Okay, you'll see that here in a second. But the first thing that's going to happen here is that you're going to get hit with an expense limitation. It's called a Section 179 expense limitation for luxury passenger autos. And you're going to be limited to deducting $12,400. Okay, that's a little nuanced. I'll explain further in just a second. And so then you bought this for $80,000. You're able to take $12,400 in sort of accelerated depreciation. And now your remaining depreciable basis, which is $80,000 minus $12,400, is $67,600. Now you're able to take bonus depreciation on this, but it's capped because it's subject to some rules I'll talk to you about in a second. But it's listed property, Section 280F. And so you're able to take $8,000 of bonus depreciation in 2024. And then your remaining depreciable basis is $59,600. And because you've taken $20,400, that's the $12,400 plus the $8,000, you can't take any other types of depreciation. So what will happen is this $59,600 will be carried forward, and you can use that in tax year 2025 assuming we're going over 2024 numbers, which we are, okay? So your 2024 depreciation that you can take is $20,400, or roughly 25.5% of the purchase price, which is $80,000. You notice that I have some asterisks here. What that basically means is that Section 280F applies, and there's a limitation, and basically the sum of your Section 179 expense, your bonus depreciation, and your MACRS, that stands for Modified Accelerated Cost Recovery System, is capped at $20,400. So technically this $12,400 could have been listed somewhere else. All I want to show you here is that you're capped. When you buy a luxury passenger auto, and we defined that earlier as basically a car that's over $62,000 in price and weighs less than 6,000 pounds, no matter if it's a SUV or a regular vehicle or a small truck, you're going to get this limitation, okay? Now, let's look at an example where you're buying a heavy vehicle. Now, by heavy vehicle, the only Tesla, well, perhaps a Cybertruck now qualifies, but the Model X typically qualifies. And so it's over 6,000 pound gross vehicle weight rating. Actual trucks have a different value. It's a little bit complicated. I've mentioned the word nuance before, but basically what I'm saying is you buy a heavy vehicle, then although you bought the vehicle for $80,000, you have to apply the different types of depreciation in this order. You can't choose the order that you do this. The first one is Section 179. So there's an expense limit in 2024 of $30,500 that you can take on a heavy vehicle like this. It's not $12,400, but it's $30,500. So that is some Section 179 expense that you can take. Then you have $49,500, which is your remaining depreciable basis. In all of these examples, I'm saying you're using this business vehicle 100% for business. So then you can take the bonus depreciation limit of 60%. All right, so 60% of this $49,500 is $29,700. So that's some more depreciation that you can take, okay? And so then your remaining depreciable basis is now $19,800. But then you can also take the MACRS depreciation, right? So that's usually the sort of 200%, double declining balance method. And so it's $3,960. And so what that means is your total 2024 depreciation between 179, bonus, and MACRS is $64,160. So you see that even though we're in tax year 2024 and bonus depreciation is limited to 60%, you're still writing off 80.20% of this vehicle in year one, all right? It's just scattered, if you will, between 179, bonus, and MACRS depreciation, okay? Now let me show you something that a lot of accountants and CPAs don't really understand, and that is there are certain vehicles that are not subject to any of these limits, meaning not the 280F limit and not the heavy vehicle limit either, capped by Section 179 or by the 60% of bonus. And those are vehicles that are like very large trucks, maybe like a hearse, which is a special use vehicle, or an ambulance. But also something people don't realize is if you're doing like rideshare services like Uber or Lyft, then that's a sort of special case where if you wanted to, if you were using that vehicle 100% for business and you weren't using that vehicle personally, you can actually take the full 100% depreciation expense as a Section 179. So you can write off 100% of that vehicle in tax year 2024. This is one that's missed a lot by folks who use an accountant or tax professional who doesn't specialize sort of in the rideshare and doesn't do the research related to this. I'm not saying I am that person. I just happen to have studied this and know how this works. But that can happen to you where you might be doing some rideshare services and be limited because the knowledge of your tax preparer is also limited. Okay, so that is how that works for depreciation. There's 3 different categories, and depending on the category of your vehicle, the amount you can depreciate is different, right? 25.5% versus 80% versus 100%. The next thing that I want to share with you that a lot of CPAs and tax professionals are missing is this concept of commuting miles versus business miles. Let me show you a quick part of a slideshow that I had done for a presentation, and that's this one here. Let me walk you through what I'm going through here. So this is your home, right? If you don't have a home office and you travel from your home to your, let's say, business office, let's pretend you're a dentist, okay? So you travel from your home to your dentist office. These miles are considered commuting miles, okay? You don't get a deduction for them. And if you're using the mileage method, you can't use these miles. And if you're using the actual method, these miles would be sort of allocated towards commuting and not business, which is lowering your business use percentage, which is thus lowering the amount of depreciation you can take, right? But then you travel or drive, from the business location to meet a colleague for lunch. And on this day, you happen to have tacos. It's an unlimited Taco Tuesday, and so you're having tacos, okay? And so this mileage is business, the mileage from the business office to the restaurant, and then from the restaurant back to the business office are also business miles, and then from the business office back to your home are commuting miles, okay? This is true, but a lot of tax professionals think that if you have a home office, that it works the same way as it does over here on the left when you didn't have a home office. So over here on the right-hand side, I'm saying you have a home office, and when you do, if this home office location is your principal place of business and you're working in the same industry, so let's say, again, you're a dentist and you do all of your administrative work or your management work out of your home office, but you go to your sort of business office to actually see patients, then you can deduct the mileage as business miles from your home office to office location number one. You can go meet your colleague and have unlimited, tacos, since it's unlimited Taco Tuesday, and then you can drive back to the office and then to your home office and get all of these miles 100% deducted, okay? And so you might want proof of that, because I understand that that's a relatively new concept for some of you, or some of you might be saying, oh no, Navi, you're wrong about this. Let me show you some guidance here from the IRS to prove this out to you, all right? I'm looking at publication 463, and it basically says here, daily transportation expenses you incur while traveling from home to one or more of your regular place of business are generally non-deductible commuting expenses. However, there may be exceptions. And one of those exceptions is your residence is your principal place of business and you incur expenses going between the residence and another work location in the same trade or business, regardless of whether the work is temporary or permanent and regardless of the distance. Furthermore, in publication 463, it says office in the home. If you have an office in your home that qualifies as a principal place of business, you can deduct your daily transportation costs between your home and another work location in the same trade or business. So make sure you're just operating within the same industry, which is why I said you're doing your dental administrative work at the home office and doing your actual patient work at the business location, okay? And then a third sort of citation for you, if you will, is talking about in publication 587, principal place of business. Your home office will qualify as your principal place of business if you meet the following requirements. You use it exclusively and regularly for administrative or management activities of your trade or business. You have no other fixed location where you conduct substantial administrative or management activities of your trade or business. So the key things to watch out here for are have a home office, use it exclusively for business, do your administrative or management work out of your home office and don't do it in your business location or your business office, if you will, and be sure that you're in the same industry and you'll be able to deduct those miles as business miles and not as commuting miles, okay? So if after watching this video, you're saying to yourself, I didn't know how all of this stuff worked, well then I encourage you to click on the link in the description below or visit my website at navimoradcpa.com to learn even more about the course I spoke about earlier. I had limited time with you in this video, right? But in the course, I unpack all of the tax strategies I mentioned today and actually teach you what they are, how to implement them using QuickBooks. I even created modules called building the foundation so you'll understand all of the terms that I was using in this video. I encourage you to join Melissa, whose savings will be $11,000 per year, or Sean, who will be saving over $6,000 per year, or even Moise, who just started his business and annually he'll be saving $4,000. So if that sounds like something you want to be a part of, then I'll see you in the course. If not, I understand. I hope you receive value out of this video, and I encourage you to subscribe to learn more in my next video. I'm going to link a video at the end of this one where I go into much more detail about the auto deduction, so I highly recommend watching it if you want to learn more about deducting your vehicle.